So welcome everybody. We've got a terrific presentation for you. I'm sure many of you, well, at least in the Ontario market, will have had an opportunity to meet Caitlin Bowie before. She's a tremendous resource when it comes to disability benefits. Very, very proficient in her trade and in her particular area of our business. Very specialized, focused on it. And so we're all I'm really happy to have her presenting today. I just want to say a couple of things really quickly. Many of you know us at RBC when our little team within what people proverbially call the group market. We're actually called the Workplace Solutions team. And there's a reason for that. And that is because the workplace is actually a tremendous marketplace for advisors to work in. It's a choice. You can choose the workplace as your area of specialization and then develop your business proposition around that or add it as a business proposition for what you do. So it starts obviously leveraging group life and health plans, group savings plans, other health and wellness benefits that you can put in place within the workplace, offering enhanced services to clients around employee engagement and connectivity. It's just engagement and success, where you can do webinars, seminars, workshops with employees as well to develop them. And then as well, there's a whole aspect of providing individual financial services and products within the workplace, be it in the construct of smaller group plans or grouping together individual programs of some kind or another. But it's a terrific marketplace to actually leverage group to also do individual in the workplace. It so happens that disability insurance is probably one of the most glaring opportunities. It's underserviced, and frankly, as an industry, I think we're not only missing opportunity as practitioners, individually as practitioners, to develop our own business there, but we really are meant to service Canadians with their financial security. And if we're not identifying this particular gap that Caitlin's going to be talking about, we're really not necessarily doing the job that we get paid to do. This is a very I don't want to say exploited, but it's an underserviced need and risk, which we're going to talk about today. There was a fellow by the name of Ralph Johnston who passed away. He had a group insurance business in British Columbia, which is still running actually. And I remember when I was a young group rep in the marketplace, he used to say to me that he would never place a group insurance case with a client unless the client would agree that they had to put in a group LTD plan. The notion was you offer a workplace for people to drive to earn a living. Well, if they lose the capacity to earn that living, what kind of insurance have you got in place for them, or are you making available to them to secure their income should they be disabled? Very, very appropriate thinking. And that was his approach to it, meaning group disability insurance is an essential aspect of any group benefits plan in that it covers people who work at a workplace for their income in case something happens. But a group disability plan does not necessarily meet everyone's needs. It's by definition based on a wide set of needs. It's a program that's developed to manage a group risk and not necessarily look at the individuals within the group. So some of the limitations that you're going to find with regard to group LTD plans, not that they're bad, they're there to service, is that for higher earners, there might be some deficiencies in the contract or in the way it works. The percentage of income replaced, for instance, which Caitlin's going to talk about, at 60% or 70% of earnings, and then capped at say $5,000, $6,000, $8,000, $10,000, certainly may not offer enough disability insurance for certain executives within a company. The next piece of gap would be definitions. While the definition of to your own occupation with any occupation thereafter certainly covers so many people, it offers a great foundation of coverage for most people who would not otherwise buy disability insurance at all. But for certain people, higher earning people, etc., it could be that they want some other kind of definitions of disability that are available in individual contracts like residual and other things that kick in, and Kate will talk more about that. And the last one is the comp structure. Higher earners often are compensated maybe a little differently with either share plans or bonus and dividends. There could be different ways that they earn income, and if the definition of income in a group disability contract does not include large chunks of the way that they earn income, well, they're not going to be insured appropriately based on their real income. So these are gaps. These are some of the gaps I think that are glaring. They're obvious, and a good advisor would be bringing these up within the context of a group sale with the executive, the C-suite. Even if it's a small company, the owners, the two, three, four primary managers who may be higher earners, that's a conversation to have with people. So with that and that introduction, I wanted to make the point that while we are the group division at Workplace Solutions, we're looking to cover up all opportunities within the workplace as to what we can deliver and make sure that we are serving those customers appropriately. And this happens to be a terrific opportunity. We're leveraging a very powerful group disability platform. You can actually leverage that to also introduce individual opportunities within the workplace. So with that, Caitlin, it's all yours.
Great. Thank you, David. Fantastic, outstanding summary, really, of the benefits of integrating some individual within a group practice, a group insurance practice, or a group insurance offering. To really bring it home for our advisors on the call, I want to share a little story with you on why this is such a glaring opportunity. So for those of you who are aware, RBC is the leading provider of disability benefits in Canada, and we have a very robust offering on both the group and individual side. And a few years ago, we had our claims team in to chat with the sales team about some of the challenges that they face on the back end. The idea behind the conference was, sales is out there making promises on the front end, claims is keeping those promises on the back end. So what are some of the synergies we need to create by just having more knowledge and awareness of what each other do on a day-to-day basis? And when this claims team was asked, what is the one message you want us on the front lines to get out to our client population at point of sale to make your job easier at time of claim? What the claims folks said is, please make sure clients are aware that what they think they have under their group benefits plan may not always be the case. And they went on to share stories about clients that they have who may have group benefits that say they'll cover 66 2/3 of their income. And those clients will then try to file a claim with us on the LTD side based on 66 2/3 of their income, or a certain portion of their income being protected. And they will realize, unfortunately, at time of claim, that they have a maximum benefit in their policy that actually caps that salary percentage. So it's not 2/3 of their income replaced if they have a $2,000 cap. It's not 2/3 of their income replaced if they have a $5,000 cap. And so claims then has to give the news to the executive who thinks that they're going to receive 2/3 of their $150,000 salary, that actually they're only covered for a much smaller fraction of what they think they are covered for. For those of you who don't know me, my name is Caitlin Bowie. I've been a living benefits specialist working with IDC and David on the Workplace Solutions team for over a decade now. And this is, as David intimated earlier, one of the single largest opportunities. And I don't think there's another product suite that is as synergistically aligned as group insurance and individual disability insurance. And certainly we see that with our advisors as well. Our top DI producers at RBC, by and large, a significant chunk of them are group advisors or have some kind of affiliation or referral relationship to group advisors. So this session is really a way to grow your group insurance business, but also to complement that group insurance business with the low-hanging fruit that is individual disability insurance. So we're going to get into that today, 3 different strategies for how we can help you do that with RBC and Workplace Solutions. So first and foremost, disability insurance is of utmost importance. And David intimated this earlier when he explained about the advisor that literally will not take a group on if they do not pursue disability insurance and meet that need with him. It is just that important to this advisor that it is a table stake offering for his group clients. Now, we're going to review that, just why disability insurance is important quickly. But then we're going to really spend most of the session today talking about where the group offerings in the Canadian marketplace leave opportunities for individual supplements. From there, we're going to build on 3 key sales strategies and then just wrap up with why RBC really shines in this space. Always leave the best for last. Really want to make sure we have enough time to cover the prospecting and sales strategies before we get into some of the products. So without further ado, I think it's important to set the table in this space by first acknowledging some of the challenges facing employers today when it comes to long-term disability insurance. And the significant challenges facing insurance companies, group providers, and employers is really born out of the fact that claims are on the rise. So disability claims are on the rise in Canada. This is a very interesting sheet because it shows that we've really been on this upward trajectory for the last 20 years or so. We're really seeing the incidence of open claims, so brand new claims, increasing. And we're also seeing that these claims are lasting longer. So that's what you're going to see with that blue line there, the termination rate indicator. You can see that clients are not only opening more claims on an aggregate basis, but they're staying on claim with us longer. So having more barriers to clients getting healthy and returning to work. And there's many reasons for this, and unfortunately that's outside the scope of the presentation today. The important thing to note is, how do increasing claims impact clients? How do increasing claims impact advisors, insurance companies, and the overall economy? And we're going to talk a lot about that, because while this, increase in claims might seem like a bad news story, it does open up some significant opportunities for us to add value as well. Now, when we're talking about the need for disability insurance within our group clients or workplace solutions opportunities, so when we're talking to our group clients, the conversation that I like to have with them oftentimes is really highlighting that with disability insurance, when you have a number of folks employed at your company, it's not a matter of if somebody at your organization is going to be filing a disability claim. At a certain point, at a certain number of lives, if you will, it's a matter of when. And so that's what this chart is really showing you. Some of you who've worked with me on the individual side know the statistic that I've offered in the past, which is 1 in 3 clients will face a disability in their lifetime. So of us on the webinar, 33% of us, statistically speaking, will claim for a disability that lasts 90 days or longer. But what's interesting is, as the number of persons in a group grows, that probability that one of those individuals will face a disability is even greater. And as you can see, if you have 4 folks who are in their 40s, the probability that at some point one of those individuals is going to face a claim is 93%, rounding up. So we're talking about something that employers need to be aware of. They need to be prepared for, because statistically speaking, they are going to be faced with this contingency at some point in time. And they really need to think about how they're going to respond to it, how they're going to handle it when that time comes. Again, not a matter of if, but a matter of when for a lot of our employers. And how long could a disability last? I think it's important as well that we as an industry are able to shed light on the length of disability claims. We never want a client to think, well, you know what, that's okay. If somebody gets disabled, we'll offer them, 6 weeks of sick pay and then they'll be back at it in no time. Unfortunately, the claims do not work that way. The average duration of a disability is roughly 2 to 3 years. And so this is what we're really preparing our employers for. Not a quick disability, a quick short term, a quick illness, use some personal vacation days and your employees are back to work, but a long-term disability that could last 2 to 3 years. And having an insurance company behind you to help you manage that disability that is lasting over a period of years, getting clients healthy and back to work isn't just good for the insured, but it's good for the employer as well. One of the biggest drains on productivity in a company's workforce is employee absences. And so working with an insurance carrier that can help get in clients back to work faster and at full capacity is only going to be a good thing. And so again, making sure we can speak to the risk, not just how many folks are entering onto claim, but how many are remaining on claim and what we can do to help is an important part of any disability insurance conversation with group clients. Okay, so once we've established that disability insurance is important, hopefully our group clients know they need it and are introducing or looking at some level of LTD coverage on the group side. What are some of the challenges that they may be faced with at this point? The first is meeting the changing and diverse needs of an aging workforce. We are seeing very significant differences in claims patterns from our baby boomer generation to some of the younger generations coming up, specifically in the utilization of mental health resources and mental health claims. As an insurance organization, mental health claims are significantly higher for our younger cohort, higher than they ever have been before. And this is something that employers need to grapple with as the baby boomers begin to retire and we start to see younger folks joining these plans who have very different utilization patterns. Employers need to be prepared for this, because if you're hiring in a climate where it's more likely that the folks that you are hiring are going to be using the disability program for mental health or, funding some of those supports, you're going to need to make sure you have a plan that's robust and can address some of these changing demographic and generational needs we're really seeing coming up the forefront. And with that, with some of these changes, it bleeds into other things. So one of the other impacts of the slide I shared earlier is rising LTD rates. So if you recall 2 slides ago or 3 slides ago, I had shared that information about rising LTD claims. This is a really significant determinant of renewal LTD rates. So for those of you who may be new to workplace solutions, you'll probably have some awareness of this, but we are seeing LTD rates, long-term disability group rates, which are annually renewable products, increase on a year-over-year basis more quickly than they have in the past. And so as more employees claim, as more employees stay on claim longer, insurance companies need to raise rates on existing enforced policy holders in order to recoup and account for some of those costs. So with this means that a lot of our organizations are grappling with rising LTD rates, rising costs of employer benefits programs at a time when we're seeing all-time high claims as well. Similarly, we're hearing a lot about increased difficulty in recruiting and retaining skilled workers. Benefits packages are becoming more important than ever. We've seen some groundbreaking improvements in our benefits industry on organizations enhancing pension offerings, benefits offerings, looking for creative ways to ensure that their key talent especially remains with the organization. When I did my MBA, an interesting statistic was shared with me, and that was that the average time in role for millennials is only 16 months. Now, this was a number of years ago since I finished my MBA, but 16 months in role was what the average amount of time our population was showing for the millennial demographic. Now, if you compare this to some of the older generations, baby boomers, et cetera, who would have, decades in the same role with the same company, it is a massive challenge. And so we're seeing this from an employer perspective. One of the best ways to retain skilled workers, obviously, is to ensure a robust and competitive benefits package. And it's more salient a need than ever with folks leaving their roles with more frequency and after a lot shorter time than was previously done in the past. And with this comes a few opportunities we have to address some of these challenges with individual solutions. And so we're going to talk about points 3 through 6 here. How can we optimize dollars spent on benefits? How can we maximize the opportunity to contain LTD costs? And what can we do to support our high income earners and make sure that we're, supporting the attraction and retention of key talent? Okay, so this leads to opportunity number 1. Now that we've got a good understanding, why is disability important? What are some of the common challenges? Let's dig in. We'll roll up our sleeves a little bit and get into the nuts and bolts of the issue. So the first opportunity, I'll say, that exists when we're looking at how we can supplement a group insurance plan with individual is the opportunity that is born out of group maximums. Now, I shared this story at the beginning of the presentation about how our claims team said, we need to make sure Canadian clients are aware of the caps that exist in their plan. So for any of you who are kind of scratching your head at that, saying, what is she talking about? She really haven't explained much. I'm going to dive into what that means. So here on the slide, you'll see the opportunity to fill what we call the disability insurance gap. Now, what's important to set the table with is that every single group plan in Canada is going to be subject to a certain maximum or maximums. It could be a non-evidence maximum. It could be an overall maximum. They could be the same. They could be different. Every group will be unique to the client company, the number of lives, and the profile of that specific group. So don't take this as gospel and think, oh, every single group out there has a $4,000 maximum. No, it depends on the group itself. This is just an example to show you how this works. Okay, so once we understand that every single group plan is going to be subject to a maximum, how does this maximum impact the earners at the organization? So in this case, if you had a group with a $4,000 non-evidence maximum, that means that without providing proof of good health, every single insured at the organization will receive a percentage of their income replaced to a maximum of $4,000. And in that case, all of the earners earning $80,000 and less at the organization would be fully protected. In other words, bringing it back to my earlier example, if claims got a call from somebody earning $75,000 with this group plan and their benefit schedule said they had coverage for 66 2/3, claims would be able to say, fantastic, you are covered for 66 2/3, and here is your benefits calculation. However, where the challenge becomes glaring is as individuals earn an income above that $80,000 threshold, but continue to be capped at the $4,000 group non-evidence maximum, we see that they're not actually covered for what they think they are, meaning they're not covered for the percentage of income stated in their booklet. In fact, they're capped at the maximum. We call this the concept of reverse discrimination. We call it reverse discrimination because, as a general rule, group benefits plans, because of these caps and maximums, inadvertently discriminate against the highest valued employees in an organization by only covering a smaller percentage of their income compared to the rest of the employee population. Allow me to illustrate. So I want to make sure that we are fully understanding what this concept looks like and how we can really provide value in these cases. Now, if you were to take, so the best way to do this is break it down with a case study. So if we were to take a 42-year-old male non-smoker, let's assume they're the CFO of the organization. They earn $240,000 plus $125,000 in bonus and have a group coverage maximum of $6,500. What we would want to do for that client is really map out what their current income replacement percentage is. And so based on the fact that, and we're going to get to this, but that in this example, most group benefit plans will cover salaried earnings only. Some will offer coverage for bonus. That is not a general rule, but most will cover salaried earnings only. It depends on the definition of earnings. We're going to assume that that's the case here. So in this case, if we look at an income of $240,000 and a group coverage maximum of $6,500, what we're showing is that Eric, the executive, actually only has 35% of his income replaced. Now, this is potentially counterintuitive to a group benefits booklet that Eric has in his possession that says he has 66 2/3 of his income replaced. So this is the situation I was talking about earlier, where at time of claim, Eric may be expecting, oh, fantastic, I'm going to receive benefit based on $240,000 of salary, $125,000 of bonus, and I've got 2/3 of my income covered. It's only at time of claim that he's going to hear from the group insurance carrier, yes, Eric, you are covered, but only to a maximum of $6,500 because that is your LTD cap under your contract. This is a classic example of underinsurance and reverse discrimination. Eric, who is the highest valued employee of his organization as the CFO, needs an individual top-up to bring him up to full insurability. And so what we would simply do is, if you look to the right-hand side of the screen here, we would offer an $8,125 individual top-up on top of Eric's $6,500 LTD contract. And then we have brought him from 35% income replaced to 78% income replaced. Much more viable a solution than leaving the client at a 65% drop in earnings. And that's really key to understanding the idea of reverse discrimination and the opportunity that exists here is, what is a palatable drop in earnings? We recommend from a financial planning perspective that clients insure 85% of their net take-home pay, thereabouts. So we would typically not want to see a client taking more than, a 15 to 25% drop in earnings. If a client had to take a 65% drop in earnings, like you see in scenario on the left-hand side of the screen here, where the client is relying on group only, that's going to result in some fairly significant lifestyle changes. And so we really want to enhance that, make sure the client has coverage that's going to properly replace their income, so they're not going to have to sell off existing assets, maybe sell off their home, move, sell their car, whatever the case may be, make massive changes to their lifestyle because they hadn't properly insured their income. So putting it in another structure, just for clear proposal purposes, we would send you out with this to show your client, the blue representing the current plan at 35% and the proposed plan at 78% take-home income replacement, obviously where the client wants to be a lot more of a healthy income replacement percentage. Now, one of the greatest opportunities that is born out of this is, once you have identified that Eric is underinsured, what do we now know about the entire rest of the organization? Well, we know that everybody in that position has the exact same problem, right? And so this is where your affiliation with a workplace solutions advocate like David, or a group block of business, perhaps on your own, is a huge advantage, because individual advisors in our marketplace have to do a lot of work and prospecting to find that Eric the executive client. Whereas those who have that inroad with the organization, the company itself, they have that information at their fingertips by virtue of having the company census listing and the group benefits already at their disposal. So then, instead of approaching each individual on a one-to-one basis, we have the opportunity to approach the organization at large and say to them, look, it's not just Eric, it is your whole company that's underinsured above this certain income level. And what can we do in those sorts of situations? Now, at RBC, we have a really fantastic offering when you bring us a client that is a top-up client and we can address it on a group basis. We're able to do something called guaranteed to issue. Now, guaranteed to issue was born out of a common challenge that we would have as individual wholesalers working through these opportunities. So what would happen a lot of times is we would be brought a client like Eric the executive and be given the opportunity to speak to the executive team. And maybe there were 4 individuals underinsured. So we would go and write up all 4 individuals for the top up coverage that you would see here. So in this case, everybody would be underwritten above the 6,500. Let's say all 4 individuals were given varying levels of coverage to bring them to their full complement. The challenge was the underwriting piece. Too often, we were seeing that clients were getting declined. And then what do you know? It's the decision maker who's been declined and the whole deal falls apart. So what RBC has done is they've said, when we're offering this opportunity on a grouped basis, we are going to guarantee to issue the contracts so that there are no declines. Meaning, if you're going out there promising your client that they're going to get an individual top up to address underinsurance, you're not then going to have to circle back and say, hey, bad news, you were actually declined, but you should still move forward with this for everybody else. We try to see the clients as a group opportunity, so we underwrite them as such. Now, guaranteed to issue, it's very important to note that guaranteed to issue is not indicating that everybody is going to get a standard offer. What do I mean by that? Not everybody in the group is going to receive coverage on a completely non-medical basis. We are still going to medically underwrite our clients, and we are still going to make a risk decision that protects us from anti-selection. So what I mean by that is, if a client were to apply, let's say with a history of back pain, we may guarantee to issue the contract, but we may issue it with a back pain exclusion. Similarly, if you had a client who applied with uncontrolled diabetes, we may still issue a contract, but we may issue a rating for the diabetes. And because it's uncontrolled, we may have to shorten the benefit period down to maybe 2 or 5 years, for example. So you can see with guaranteed to issue, it is a fantastic solution, but it is still a medically underwritten solution. So we're still meeting with each executive. We're addressing their underinsurance on an individual basis, and we are providing that top up, but we're going to guarantee everybody gets a contract, albeit not a standard one. Now, in order to do this, in order to offer this to our employee clients and organizations, we typically recommend that in these cases, our employers fund this for their executive team. And that is what we call setting up a wage loss replacement plan. For those of you who are not familiar with the concept of a wage loss replacement plan, it is simply the ability to set up executive level benefits as a tax deduction to the business The premiums are not added as a T4 to the employees or owners' income, T4 at the end of the year, and there is no tax burden at time of claim. And as a result, we would gross up the benefit to its non-taxable equivalent. So if you recall from our prior slide, where I showed Eric, the executive, purchasing a top up of $8,125 on an individual basis, when we offer this solution on a group basis, we again typically offer that the employer pay for it. And we do this for a number of reasons. We do this, A, because it's the most tax efficient way to structure benefits by and large. B, then to address a very salient problem within the client's group benefits package, we only have one decision maker signing off on this, as opposed to going to each individual executive and having them sign off or agree to pay for this out of pocket. And C, we spent a lot of time earlier in the presentation talking about why attraction and retention is so important. It's going to be a much more powerful attraction and retention tool if this is an employer paid benefit. Now, this does not mean that the LTD, the group long-term disability offering, has to also be taxable. Oftentimes, it's a very popular approach for our clients to leave the base long-term disability with the tax status that it already has, whether taxable or not, but structure the individual top-ups for the key executives as taxable. So what I wanted to show you on this slide is that where we would offer Eric, the executive, $8,125 of non-taxable benefit to top up that $6,500 and bring him to full complement. If we were to make that a corporately paid benefit, where it then becomes taxable, we would want to offer a $14,425 taxable top up. Okay, so just very simply speaking, $8,125 non-taxable is equivalent to $14,425 taxable. And it's important to understand that gross up, because when you understand the gross up, you realize that the insured incurs no tax, detriment, if you will, no tax consequences at time of claim, because we've handled the taxable benefit with a gross up. Similar to how you would see a group LTD schedule that was paid on a taxable basis, grossed up usually compared to a non-taxable schedule. Okay, so to offer our guaranteed 2-issue program, we typically do want to see that it's an employer paid program. We need a minimum of 2 lives, and we can go all the way up to as many lives as possible, but you'll see that at 10 lives, we have another solution that's quite creative that we can use. Clients receive a 20% premium discount, and of course, they're going to receive coverage on a guaranteed 2-issue basis that they may have had trouble otherwise qualifying for. Okay, so what are some of the advantages to the employee? Well, when we structure these top-ups on a group basis and we have the employer pay for it, it's no cost to the employee. So sometimes I get the question from advisors, can an employee opt out? And I always say, well, yes, but they almost never do, because why would they? It's not something that they have to pay for out of pocket. All they have to do is go through the underwriting process. In 12 years of offering these programs, I only had an employee opt out once, and that was simply because they were going through a divorce and didn't want their disability policy factored in as an asset until the divorce was wrapped up. Other than that, the employee is always going to wish to participate with this program, generally speaking. And the other fantastic benefit of it to the employee is it's portable, right? So because it's an individual contract, if they ever leave the organization, they can take the policy with them. They would still retain that GTI offer, that guaranteed 2-issue offer, and that 20% discount. As an employer, premiums are tax deductible as a business expense. You're able to attract and retain talent. And last but not least, which is very important, cost containment. Okay, so we haven't spent a lot of time talking about this yet because I was waiting for this moment and the next concept which we're going to discuss. But keeping in mind that individual premium, individual insurance, once put in place, is guaranteed level for life. As long as we're using our non-cancelable products, so professional series or foundation series, the premium on those products is guaranteed to age 65. And so earlier in the presentation, when we talked a lot about the rising LTD costs and some of the challenges this is presenting in terms of increasing LTD rates, more and more employers are open to the idea of using individual coverage to help supplement their group plan because that individual coverage is offered at a fixed rate. And they like that stability in a climate where costs are constantly increasing. They love to be able to put a little bit of their group volume, a little bit of that disability risk on a pricing platform that is never going to change. Okay, and for the advisor, it's a fantastic prospecting tool. As I mentioned earlier, the amount of work that would go into identifying one uninsurable individual, or sorry, underinsured individual would mean building that relationship with that prospect, slowly turning that prospect into a client, requesting a copy of their group benefits booklet, quoting them individually, getting them to pay for it with after-tax dollars. When you prospect through your group, you don't have to do any of that. Instead, you're just working with the employer. You're getting one yes and hopefully multiple policies out of that. So it's a really fantastic prospecting tool. It lends to all sorts of cross-selling opportunities. I've done this for over a decade, and I've seen advisors, develop entire family financial plans, take over existing assets, do child par for these executives, all just from identifying underinsurance in one of their group clients and making sure that everybody is having that conversation with the advisor. Okay, so there's a couple open-ended questions to open those client discussions. This is a recorded session, so I'm going to leave this as a resource you can refer back to at your leisure. I am also here to help support you if you need assistance on how some of the top advisors in this space are really opening up these discussions with their group clients, with their workplace solution clients. By all means, you can reference what's on the screen or reach out to me. I can certainly support you with pre-approach letters, packages, etc. And I know David and his team are really far along in integrating the pre-approach process into their own renewal solutions and whatnot. So definitely we have full support for you. If you're not sure where quite to start, reach out to David or myself. We can certainly assist. Okay, now one of the other questions, this is more of an exhibit. As you can see, I've labeled it Exhibit A, but I'm not going to spend a ton of time on this. It's just for anybody on the call who's maybe a little bit more technical and maybe thinking as we talk about...
Okay,
pardon me?
Sorry, I'm just jumping in. I'm not sure. There's two questions in the Q&A. Do you want to just stop there and answer those in particular?
Sure. Would you be able to read them to me, David? I'm just, I don't have access to my chat.
The first one is, does wage loss replacement program, WLRP, require a certain level of ownership? For example, 10% or more of the shares?
Great question. No, it does not. The wage loss replacement plan doesn't require any ownership. We do allow owners to participate, and certainly even we allow owners to set up like shareholder only classes, but that's actually not the norm. That would be sort of the minority of cases. Oftentimes, this is, while the owners are participating, this is something they're extending to any of their key people who are underinsured as a means to reward them with a more fulsome benefit package. So that would be definitely employees, their key people, their key executives, whoever they deem that they want to extend this to. They do not have to have ownership stake.
from my own end, and it's not. I don't think it's said that as a statement, but in terms of that prospecting piece about wage loss replacement programs, it's the same thing to say, and probably everyone already has guessed on it. The wage loss replacement is just a structure, right? And it's a CRA allowance structure. So it's a concept used to present to executive employees, etc. But at the same time, you could do individual disability contracts in the workplace outside of a WL, right? It could be either way. Just there are advantages to the
Yes.
Right. Okay.
Absolutely. The big difference is that when we do individual disability insurance outside the WLRP, that would be like that first opportunity I explained, where the advisors on an individual basis are working with an individual client on their own personal financial plan. Oftentimes, when we're doing it through the group, we do recommend that the employer endorse it and pay for it. Otherwise, in our experience, oftentimes the employer might say, yeah, sure, great. Reach out to my employees by all means, talk to them about underinsurance and see what you can get out of it. But in those cases, it still ends up being an individual solution. It's not usually something that's funded by the employer. In those instances, it's often better that they just set it up on an individual basis.
Suffice to say that in order to ensure participation, if the employer's objective is to ensure that each of their executive team or higher earning team is appropriately insured, then applying group principles to the way that they administer the program is appropriate. Otherwise, they're leaving it up to each individual to take care of their needs, and that could leave maybe liability for the employer where they had put something out, implied to employees that they would be covered for something, then they end up not being covered, etc. So the wage loss replacement program is a great structure to formalize the admin around it. But then the question would be, they could still bill the premium to the employee, pay for them, but to keep it a non-taxable benefit if collected, they could still have the employee pay for it through a payroll deduction. Or is that not a true statement?
Absolutely. That is a very true statement. You could do that. We typically recommend against it for exactly what you're seeing on the screen here. So if you do, and that's, and I will pause after this for the second question as well, David. But the reason why, and again, this is an exhibit. I usually don't present this on webinars, except to address maybe some folks whose kind of wheels are turning on saying exactly what you just intimated. Why wouldn't we just do this as a payroll deduction? Why have it company owned and paid? Essentially, it all boils down to it is much more tax efficient to structure this as a wage loss replacement plan, because when it is added as a payroll deduction, you're paying for it with after-tax dollars, and it's not deductible as a business expense unless you're issuing a T4 for a taxable benefit, which again gets added to T4. So what this screen is showing you, and it's very technical, outside of scope for today, but really just the takeaway is that we will support you with the appropriate analytics to show the client company what's behind our recommendation. And typically we recommend employer paid because it results in more net savings to the employer. So payroll deductions, in this case, this is a real life case, would result in a bill of $96,000 because we would have to factor in that we're using after-tax dollars, whereas the wage loss replacement plan, when we're using before tax dollars, is much cheaper. So in this case, there's a 36% savings in it for the employer if they do this corporately versus owning it personally.
Right. The second question was about a lot of information. So please come through to your business development executives on the group side. You've got Ling Wang in British Columbia, you've got Candy in Alberta, Marnie, and she'll look after Saskatchewan as well. Marnie here for Ontario, Iki Joannius in Quebec, and Riley Hurley who's out in Atlantic. If you've got any questions, we can bring those into us. If you've got documents or tools like what Caitlin has been talking about, we have some. We've modified some of the things that Caitlin's team has built, but Caitlin's got a ton of it's got a pretty cool toolkit built out, I think. Maybe, I'm not sure if it's actually a formal toolkit, but certainly tools of various types that can support you in demonstrating this opportunity when you're in front of a client. So please come back to us if you've got any particular questions. Cora, I'm going to leave it to Lisa Friesen to maybe get in touch with you to let you know how we can get you more information regarding your question about the information. So then the last question here is, in certain cases, is the LTC conversion excluded in the contract?
Great question. Yes. So we do always reserve the right to underwrite the long-term care conversion amendment. So for those of you on the call who don't know the context of that question, all RBC individual disability insurance contracts, with the exception of our fundamental series, all fully underwritten contracts include a conversion to long-term care insurance built right into the policy between the ages of 55 and 65. However, at time of underwriting, we do reserve the right to remove that long-term care conversion if the risk is too high. So let's say we were working with an executive team and we had a guaranteed 2-issue offering. So we are obligated to make an offer of professional series to that team because of our GTI program. However, we are not obligated to recommend the long-term care conversion. So that is assessed on an individual case-by-case basis, whether your clients will receive the LTC conversion. Okay, so if there are no other questions, I'll move on to the final concept that I wanted to discuss today, and that is our guaranteed standard issue program. Okay, so just to kind of recap where we've come from, set the stage for where we're going in the next kind of 10 minutes or so. We started off with Eric, the executive, that single individual client that you're looking to work with. And then we grew to including not just Eric, but the entire executive team by offering our guaranteed 2-issue program. But as we discussed the guaranteed 2-issue program, we did uncover some limitations, and that is the fact that we still are going to underwrite each and every client because we have to protect ourselves and we have to make sure that we're not anti-selecting. However, this is what gives rise to an even more exciting solution, which is called our guaranteed standard issue, which says if you bring us a minimum of 10 lives, not only are we going to guarantee to issue the contracts, but we are going to guarantee that all of those contracts are going to be standard. And so this is called guaranteed standard issue. And it speaks to the fact that everybody is going to receive an individual, non-medical, no underwriting policy with a deep 25% discount. Okay, so it's a really fantastic offering. The catch, if you will, is that we only offer our GSI solution, our guaranteed standard issue solution, when we have a minimum of 10 lives. It is mandatory, meaning we cannot pick and choose if we're offering this to, 10 executives or 10 accountants or a 10 life marketing company. Everybody has to participate based on class. Okay, so same group principles apply, mandatory based on class. And it is only offered to our white collar employees. Okay, so we do not offer guaranteed standard issue to our blue and gray collar employees. So things like warehouse workers, manufacturers, laborers, etc. This really is an executive kind of white collar solution, and is oftentimes born out of the opportunity where you have group benefits, NEMs, being capped for a larger group. Okay, so if we're going to look at the various GSI structures, how do we set these types of programs up? Essentially, you're going to 9 times out of 10 set these up as an integrated plan. So what that means is you're going to set these up as a complement to your existing group benefit. Now, we can participate with another carrier, typically called a top-up. So let's say very simply, we have Eric, the executive. He's got a $6,500 group LTD NEM. We might do an additional $2,000 of individual GSI, and that would be extended to everybody on his executive team. So now we have brought the LTD from the non-evidence maximum, rather, from 6,500 to 8,500 without any proof of good health or medical evidence in this case. Okay, so it will typically float on the existing group. It is best used in situations where we're topping up another carrier. Okay, so we do not have to own the group in order to provide GSI. So if you have a minimum of 10 underinsured lives, but they're happy at, let's say, our big yellow sunny friend, then we can leave the LTD there and simply top up at RBC. And we would typically look at this solution when your clients are enjoying a low LTD rate, as it is more affordable to leave, the dominant portion of the volume on the existing group plan. Now, sometimes it makes sense to bring the entire benefit over to RBC. So sometimes it makes sense to say, you know what? We're not going to leave the benefit with the incumbent. We're actually going to bring it over to RBC, and we are going to offer the integrated GSI individual solution with our RBC LTD. Now, there's a number of benefits in doing this. Essentially, you have much more synergy at time of claim. We make sure the terms and conditions on the contract match. So we ensure that the group pre-existing condition clause matches, the definitions of disability matches. So ultimately, in my view, it is a better client experience at time of claim when we can bring the entire group over. And it prevents a unique opportunity for clients who do have an LTD rate over $2. Because in these cases, we usually find clients are more willing to look at a locked-in rate solution, as I mentioned previously, keeping in mind that anytime we offer GSI, those rates are guaranteed level till 65. And so oftentimes our clients with higher group rates have more of an appetite to look at moving that group to RBC on an integrated basis, so we can lock in a larger portion of the volume on that guaranteed rating platform. Now, I think this presentation has done a really, hopefully you agree, a good job of really talking to some of the quantitative reasons why individual can be a fantastic solution and a really great complement to group. We talked about addressing underinsurance. We talked about the need to offer, rate stability and how individual in conjunction with group can do that. And then with the wage loss replacement plan, we really looked at how, with tax efficiency in mind, we can make sure that clients are getting the most out of their premium dollars. But we haven't as much talked about the qualitative benefits of these programs. And I think it's a little bit outside of the scope of today, because I could probably do, a whole presentation just on the differences between group and individual. Yeah, but really what I...
Do you mind if I just interrupt? I'm really sorry.
Yeah, please.
I actually have to get out to a client meeting that's in Pickering. So I've got a half an hour travel to get there for a 2:30 meeting. So I'm not going to be able to just sign off. I just wanted to, I wanted to say to everyone, thank you so much for attending. Caitlin, thank you for an outstanding presentation. And if you do believe that we need to kick into a second webinar, Lisa's backstage. She's tracking it. If people are interested in a second webinar to get into the qualitative conversation, I guess, if that was what you were suggesting, there should be another section to this, we could certainly schedule another an hour to deal with this if you want to do that, Caitlin. We'll leave that up to everyone else. But I would leave you guys to keep running if you want to keep running. I'm going to take off, and thank you so much for everything, Caitlin.
Thanks, David. And Noah, thank you so much for the offer to keep running. I want to be respectful of everybody's time. And I know we have scheduled this to 2:00, and this is, exactly what I was hoping to cover today, is really just highlighting where these opportunities are. But again, as I was saying, I do really want to leave everybody on the call with the understanding that we've really only scratched the surface today, talking about, again, the quantitative reasons why you would offer individual to supplement your group plan. We haven't even got into all of the qualitative stuff, talking about definitions of disability, how important it is for our, top income earning professionals to have a residual definition of disability, to have own occupation to 65, to have that portability, that convertibility, the ability to, extend the benefit beyond 65. So what I wanted to leave you with is really just understanding that individual is there not as a competitor, but as a complementer. It is there to help bolster and support your group benefits offering so that you're not only offering the most coverage amount at competitive prices and locked in rates, but that you're also tailoring the plan with the qualitative features that more appropriately meet the client's needs. David and his team have had a ton of success offering these integrated solutions over the past 12 months. It's been a pleasure working with him and the team, and I'm really looking forward to working with everybody on this call. We'll reach out after the call to let you know who your contact is at RBC, who your wholesaler is. And I would just leave you with the last kind of thought is, if something that you heard from today's webinar resonated with you, and if this was something that you were sitting there thinking, wow, I do have opportunities, or I want to break into this space, then don't wait for us. Reach out, because if we don't do something about this in the next kind of 2 to 5 days after attending this webinar, chances are we're probably going to forget what we learned here today. So don't wait for us to reach out to you. Reach out to David, reach out to David's team, reach out to myself. We're here to support you. We're here to help you grow your business and make sure that we're better wrapping a fence around these clients and ensuring all of their needs across all lines. Thank you very much for your time and participation. If there are any questions, by all means, you can put it in the chat box. I'll remain online and take down the questions, and then I'll send a note out to Lisa after to distribute. Okay, thanks everyone.